Hi, I'm Frank Flegg, founder of Ethical Property Partners. Something really interesting's happened over the last few weeks. We've had an influx of inquiries from experienced property investors wanting to capitalise on this extraordinary opportunity to invest in property. Now, this is at a time we're in the middle of lockdown when most novice investors, most newbie investors are running for the hills. They are scared of change. But what an experienced, sophisticated investor recognises is that when the market is running away from buying, when people are hoarding their cash and are scared to invest, that's actually when the real opportunities are abound, because there are always people who need to sell. And if there are less buyers, but there are still people that need to sell, then that poses an opportunity because we're in a buyer's market. We can negotiate better terms. So in this video, I'm going to explain to you the 5 strategies you should be using during a recession to invest in property. And I'm actually going to turn it into a 6-part mini-series where I go in depth into each of those strategies in a separate episode. So let's talk about strategy number 1, vendor finance. Now, vendor finance is a brilliant strategy in a recession because it doesn't require any of your own money. In effect, if a vendor has an unencumbered property, this only works on unencumbered properties where there's no existing mortgage, the vendor lends you the money to buy the property. Now, that sounds crazy to an inexperienced investor, but I've done this many times and my clients have done this many times as well. And so let me give you one example. I purchased a £250,000 property, £250,000, with only £15,000 of my own money. I actually borrowed £235,000 from the vendor. So they become the mortgage lender in effect. And some of my clients have done 100% vendor finance, which means you don't require any deposit at all. And I pay a monthly interest fee to that vendor. It was actually a 15 years fixed rate mortgage at a very, very low interest rate because the vendor needed to sell. And that meant that I could buy their property that otherwise wouldn't have stacked up on a conventional mortgage. And if you do your sums, that's a 97% loan to value, 15-year fixed rate buy-to-let mortgage, unheard of. So vendor finance is a really effective tool. Last week, I offered £1.1 million asking price. I offered asking price on 100% vendor finance over 12 years. And what I did is I know I can achieve £3,000 a month rent. I offered £2,000 a month repayment on that mortgage, no interest. So actually it's a £1.1 million loan from the vendor, interest free over 12 years. And if you do the sums, £2,000 a year, paid for by the tenant, I'm still making £1,000 a month, paid for by the tenant, that £2,000 over 15 years comes off the purchase price and the balance is due in the 12 years time. So really, really profitable strategies these are. So that's the first one, vendor finance. The second one is perhaps you don't want to buy the property, perhaps you don't want to pay stamp duty right now, perhaps the vendor's not in a position to offer vendor finance, perhaps they don't like the sound of it, perhaps they've got a mortgage. Exchange with delay completion is the second strategy. Now, an exchange with delay completion, normally you exchange and you complete 4 weeks, 6 weeks later. But in an exchange with a delayed completion, it could be 4 years later, 10 years later. We did one a few years ago, 15-year delay between exchange and completion. And what happens is you still fix the price, so you fix it at today's price, whatever you agree with the vendor. You sometimes pay a deposit, normally not. Normally it's a nominal £1 deposit. And then you pay an amount each month, either towards the purchase price or as an inconvenience payment or an interest payment. It's a bit like a rent to rent, but with a definite purchase at the end. So exchange with delay completion can work really well where you know you definitely want to buy the property, but you perhaps don't want to complete on it right now. Our third strategy is similar to the first two, a purchase lease option. So in this case, you actually aren't legally committed to buying the property. So in this case, you have the option to buy the property, and then you pay a lease payment every month between when you sign the property up and when you actually buy it, if indeed you do buy it. So again, you could do the same property on vendor finance, you could do the same property on exchange with delay completion, or you could do the same property on a purchase lease option. And again, you fix today's price, you pay a monthly amount, which is paid for by the tenants, and then you have the option of buying the property. And that works really well in a recession where you're not sure of capital appreciation in the future. If you're doing vendor finance or you're doing exchange with delay completion, you want to know that the term is long enough and that the part of the country you're investing in is really good for capital growth long term. If you're in an area where you're not quite sure on capital growth, or you're doing the period quite short, so perhaps you've got an elderly vendor and they're not willing to make it a willable asset, they want it done in quite a short time frame, a lease option is often a better option for you, because you can make money on the property, but if it doesn't appreciate in value, then you don't have to buy it and you've just made cash flow in the interim. So that's vendor finance, exchange with delay completion. You've got purchase lease options. Number 4 is rent to buy. Now, rent to buy is a really interesting monetization strategy. It's actually where we take properties that we've secured, and it could be ones that we already own, it could be ones that we've used those first 3 strategies on, but in this case, we're actually helping a tenant to buy from us. So what we do is we fix the price with them, not normally at today's values. Normally we add a percentage to it, perhaps 10%, perhaps 20% to that value, but they fix that price now and they pay a rental amount. They take over all maintenance for the property. They pay a rental amount each month and they start contributing towards that purchase price as well. So for us, often we can treble, quadruple our monthly cash flow from the property. They take over all maintenance, we don't require a letting agent, and their investment in that property is really high because it's theirs. If they put an extension on it, if they put a conservatory on it, it raises the value of their property. And then they complete at a time when they are able to get a conventional mortgage. So this is great for people who've recently arrived in the country, having immigrated to the UK, or it's great for people who've recently started a business and making good money, but they're not in a position to get a conventional mortgage just yet. So rent to buy is a really good option to be using during a recession to help others to buy whilst maximizing your cash flow. Really important to get cash flowing through your business during a recession. Now, the 5th strategy is a bit of an unusual one, and I'm going to coin it as icing on the cake. So if you've watched my other videos, you'll be familiar with my educational concept of the cake. And when I talk about the cake, I mean that the deal, a property deal, has got to work in its simplest format. So its simplest format is a single AST, for example, a single couple or a single person or a single family renting your property. And it has to cash flow and make you good money on that basic rental model. The icing on the cake is anything you might do in addition to this. Now, the deal doesn't require you to put icing on the cake, doesn't require you to use an enhanced monetization strategy, but it's just a bonus if you can do it. And you want to be looking for deals in a recession that have multiple potential layers of icing. So you might look for a property that works just great, makes you 50, 100, 150 pounds a month positive cash flow, ideally with none of your own money in it. And if you can buy an infinite number of those, then fantastic. You're looking for deals that work on a single AST, but then you can do something else to them potentially. So ones that would work really well on a single AST, but also serviced accommodation, or also as a blue collar HMO, for example, or perhaps also as emergency accommodation for the council. And if you can find a layer of icing on a property, often your workload will reduce, not always, but often it will. So for some of our strategies like Stepping Stones, where we lease a property to a charity and house the homeless in that property, those strategies can be lower weekly time input than a single AST property, but your cash flow from a enhanced monetization strategy can often be double, treble, quadruple what it would be on a single AST. So the fifth strategy is to look for properties with layers of icing, and I'll go into more detail on those in this mini series. Guys, if this is your first time to our channel, please don't forget to click the bell, the notification bell, click the subscribe button so that you're notified about our episodes as and when they come out. And if you have any questions at all, feel free to pop them in the comments box below and we will happily answer those for you. Happy investing, guys.